If you have a second, I want you to mentally pull up your banking app.
Or honestly, just look inside your physical wallet if you still carry one.
Yeah, right. Because you're looking at US dollars. You see the balance, you know what it buys at the grocery store, and you know, intuitively that it is backed by the full faith and credit of the United States government.
That's the baseline assumption we all have, right?
Exactly. But what if the vast majority of the world's actual dollars, the dollars that fund massive global trade networks, the ones that dictate whether markets soar or completely crash, aren't issued by the US government at all?
It is a concept that kind of shatters your entire baseline understanding of money when you first really encounter it.
I mean, what if these dollars aren't regulated by US banking laws and for the most part aren't even located within the United States?
Because we are all deeply conditioned to view a currency as a sovereign tool. A neatly closed loop managed by a central bank sitting in some big marble building in Washington.
Right. But the reality of the modern monetary system is that it relies on this colossal offshore shadow infrastructure, and it functions essentially as a monetary black hole.
A massive, invisible plumbing system.
Welcome to today's deep dive. We are taking you into that invisible plumbing of the global financial system to map out something called the Eurodollar system.
It is such a fascinating, misunderstood topic.
It really is.
Yeah.
We want to explore how this system allows for ultimate regulatory arbitrage, how it concentrates wealth through these hidden institutional relay nodes, and why the global economy might actually be teetering on the edge of a collateral freeze.
And to map this all out, we are synthesizing a really massive stack of sources today.
Oh yeah, the reading pile was huge for this one.
It was. We've got historical documents from the Federal Reserve Bank of Richmond and the Library of Congress. We are bringing in the relay power model, which is this incredible network analysis of global decision systems.
Plus the real-time market warnings from Jeff Snyder at Eurodollar University.
Right. And we're also pulling insights from the Paradise Papers, the Solari report, and structural analyses of American corporate power. So a lot of ground to cover.
The mission here is to trace the actual flow of power and money. We want to figure out how this system operates without relying on centralized conspiracies and what happens when it all starts to break down. So, okay, let's unpack this.
Where do we start?
Well, before we can peer into the black hole of the shadow system, we have to look at the visible cage that was built to contain it.
Meaning the Federal Reserve.
Right. A brief history of the Fed. Because you cannot understand why the capital escaped if you don't understand the mechanisms they originally tried to lock it down with.
Yeah, the entire history of central banking in America is, well, it's a really agonizing tug of war.
How so?
On one side, you have the desperate need for economic stability. But on the other side, you have this deep-seated, distinctly American paranoia regarding concentrated financial power.
And we can trace that paranoia all the way back to the founders, right? Like Hamilton versus Jackson.
Exactly. You have Alexander Hamilton aggressively setting up the first bank of the United States to manage the Revolutionary War debt, and immediately there's massive pushback.
People hated it.
They did. Fast forward to the 1830s, and you have President Andrew Jackson waging this all-out political war to destroy the second bank of the United States.
The famous bank war?
Right, because he viewed it as a corrupt, unconstitutional monopoly that was basically favoring the elite over the agrarian class.
And Jackson essentially won that war, didn't he? He vetoed the renewal of the second bank's charter in 1832.
He did. And the consequence of that was fascinating. For the rest of the 19th century, the United States operated completely without a central bank.
Which just sounds like absolute chaos.
It was heavily chaotic. To try and create some semblance of order, the government passed the National Banking Acts in the 1860s, right in the middle of the Civil War.
And those acts established national bank charters, right?
Yeah, and crucially, they required those banks to back their paper currency with U.S. government securities.
Okay, let's unpack that specific part, because on paper, that sounds like a totally reasonable safety measure. You back the money with government bonds. Why was that entirely inadequate for a rapidly industrializing country?
The fatal flaw was that it didn't create an elastic currency.
Elastic meaning it can stretch and shrink when needed.
Exactly. Imagine the American economy in the late 1800s. It was heavily agricultural. During the fall harvest, farmers across the entire country needed massive amounts of cash at the exact same time to move their crops.
To pay workers, transport goods, all that.
Right. But the local banks couldn't just create more currency to meet that huge seasonal demand, because their ability to issue notes was strictly tied to the physical amount of government bonds they held.
Oh, wow. So they were essentially wearing a financial straitjacket.
Completely. If they didn't have the bonds, they couldn't print the cash, no matter how desperately the local economy needed that liquidity.
Resulting in these incredibly volatile, devastating boom and bust cycles.
Cash reserves were totally immobile. When a local panic started, banks would just hoard whatever cash they had, completely starving the economy.
And this all kind of came to a head in 1907, right?
Yeah, the severe depression of 1893 was bad, but the absolute breaking point was the panic of 1907.
1907 is such a pivotal moment. You had this failed short squeeze on copper stocks that ended up triggering a massive run on the Knickerbocker Trust Company in New York.
Right, and the contagion spread instantly.
And what always strikes me about 1907 is the disconnect. Wall Street was completely cratering, trust companies were going bankrupt overnight, but the actual physical economy of the United States was largely prosperous at the time.
The factories were running, the farms were producing a lot of food. The panic proved undeniably that the structural plumbing of the financial system was broken.
Not the businesses themselves, but the plumbing.
Exactly. And because there was no central bank to step in, the crisis was only stopped because J.P. Morgan, the private banker, essentially locked the city's top financiers in his private library.
It literally locked the doors, right?
Literally locked them in and strong-armed them into pooling their own money to bail out the system.
Which is just a terrifying way to run a country, relying on one incredibly wealthy guy to personally act as the central bank.
It terrified the politicians in Washington. It led directly to the 1908 Aldrich-Freeland Act and the creation of the National Monetary Commission to figure out a permanent solution.
But you mentioned that American paranoia about centralized power earlier. It was still boiling over at this time, right?
Oh, absolutely. In 1912, the House Banking and Currency Committee, specifically the Peugeot Committee, held these highly publicized hearings.
And their conclusions sent shockwaves through the public. They formally declared that America's finances were being controlled by a money trust.
A money trust.
Let's define that, because honestly, it sounds like a conspiracy theory born in the early 1900s.
The committee's exact framing was that there was a vast and growing concentration of control over money and credit in the hands of a comparatively few men.
Meaning J.P. Morgan and his buddies?
They were pointing directly at Morgan and his allies. They argued this tiny syndicate could dictate the terms of credit for the entire nation.
So when Woodrow Wilson won the presidency in 1912, he and his allies were dead set against any central banking system that handed the keys over to Wall Street.
But Wall Street was arguing the exact opposite. The major financiers were looking at Europe, looking at the Bank of England, and saying, if America wants to be a global superpower, we need a massive, dominant central bank in New York.
They wanted a behemoth institution that European central banks would actually respect and deal with on equal footing.
Right. So the final result was the 1913 Federal Reserve Act, and it was a masterpiece of political compromise.
How so?
To satisfy Wall Street, they created the system. But to soothe the politicians who feared the money trust, they decentralized it.
Okay, so they spread it out.
Yeah, they created 12 private regional reserve banks spread across the entire country, supervised by a politically appointed central board in Washington.
Though the New York Fed did become the largest, right? Opening its doors in 1914 with just a handful of officers.
It did, but its power was intentionally diluted by the regional structure.
And the government honestly patted itself on the back here. They thought they had finally put a leash on global capital.
They thought they had solved the puzzle.
They built a system that could provide that elastic currency during harvest season or panics, while theoretically ending the power of the unregulated money trust.
They engineered a domestic cage for a domestic currency.
But it's so ironic. It's like building a massive state-of-the-art dam to control a river, completely ignoring that the water has already figured out how to seep into the groundwater and flow right under it.
That is the perfect analogy. Money is like water. It relentlessly seeks the path of least resistance.
And the capital did not stay on the leash for very long. It simply moved offshore, which perfectly sets up the reality of the shadow system and brings us to Section 2, peering into the black hole. What actually is a Eurodollar?
Let's start with the name itself because it is incredibly misleading.
Yeah, when you hear Eurodollar, you immediately think of the euro, like the paper money used in Paris or Rome today.
Right, but it has absolutely nothing to do with the modern European currency. The term is a historical artifact from the Cold War era.
So where does it come from?
If we look at the definitive text from the Federal Reserve Bank of Richmond. A Eurodollar is defined quite simply as a bank deposit liability denominated in U.S. dollars, but located outside the United States.
And therefore not subject to U.S. banking regulations.
Exactly. That is the key part.
So if I take $1 million US and put them in a bank in London, those are Eurodollars.
Initially, yes, that was the exact mechanism. In the 1950s and 60s, communist countries like the Soviet Union and China had trade surpluses in U.S. dollars.
Because they were trading commodities globally.
Right, but they were terrified of depositing those dollars in New York banks, fearing the U.S. government might just freeze or seize their assets during a geopolitical dispute.
Which was a very valid fear during the Cold War.
Absolutely. So they deposited those U.S. dollars in European banks, specifically in London and Paris. Hence the euro prefix.
But it obviously didn't stay confined to Europe.
Not at all. As global trade expanded, the demand for dollars to settle international transactions just exploded. Today, a Eurodollar deposit can be held in the Bahamas, the Cayman Islands, Hong Kong, Japan.
So the geographical location doesn't matter anymore.
The only defining characteristic of a Eurodollar is its regulatory geography. It exists outside the jurisdiction of the Federal Reserve and the U.S. government.
I need to pause you here because I really want to make sure we understand the actual mechanics of this. How does a bank offshore actually create a dollar without the Federal Reserve printing it? Walk me through a hypothetical transaction.
Sure, let's invent a scenario. Imagine a massive German manufacturing company sells a fleet of industrial machinery to a buyer in South America. The contract requires payment in U.S. dollars because the dollar is the global reserve currency. Everyone accepts it. So, the South American buyer transfers $10 million to the German company's bank account in Frankfurt.
Okay, so the Frankfurt Bank now has a deposit of $10 million.
Now, what does a Frankfurt bank do with that deposit? If they were a regular bank in Chicago, they would be subject to U.S. Reserve requirements.
Right, the Fed steps in.
The Federal Reserve might tell the Chicago bank, you must keep 10% of that deposit in a sterile, non-interest-bearing account at the Fed, just in case there's a bank run. You can only lend out the remaining $9 million.
Like a pizza. You have to leave one slice in the fridge. You can only sell the rest.
Yes, exactly. But our bank is in Frankfurt. It operates in the Eurodollar system. It faces zero U.S. Reserve requirements.
Zero.
So that Frankfurt bank can turn around and lend out the entire $10 million to, say, a real estate developer in Dubai who needs dollars for a construction project.
And when they lend it to the developer in Dubai, they just credit his account with $10 million. They just type the numbers into a ledger.
They created a $10 million liability out of thin air.
That is wild. The Federal Reserve was not consulted at all.
No. The U.S. government did not approve the loan. No physical paper money ever crossed the U.S. border. It is entirely a shadow ledger system.
The efficiency is obvious, but let's really dig into the incentives. Why did this offshore market grow so astronomically large? Why did all the major financial institutions rush to participate in it?
It comes down to one of the most powerful forces in finance, pure regulatory arbitrage.
Basically finding the legal loopholes to make more money.
Precisely. Operating a bank inside the United States is expensive. You have those non-interest-bearing required reserves acting as a tax on your capital.
Right. The pizza slice in the fridge isn't making you any money.
Exactly. You also have to pay premiums to the FDIC for deposit insurance. You have strict capital adequacy standards and armies of regulators crawling through your books.
So the banks operating in the Eurodollar system avoid all of those costs.
Every single one. And because their overhead is lower, they can outcompete domestic banks.
That is the engine driving the entire system, isn't it?
Because an offshore bank doesn't have to park 10% of its money at the Fed for zero return, and because it doesn't pay FDIC premiums, it can operate on razor-thin margins.
So it can offer slightly higher interest rates to depositors to attract their money.
While simultaneously offering slightly lower interest rates to borrowers, a heavily regulated onshore bank simply cannot compete with that math.
And here's the craziest detail from the source material. We think of this as happening in London or the Cayman Islands. But the sources highlight that these unregulated offshore transactions can actually happen geographically inside the United States.
This is where it gets really strange. Through an innovation called International Banking Facilities, or IBFs, which were established by the Fed in late 1981.
Explain IBFs to me.
IBFs are essentially separate sets of books maintained by a U.S. bank. They allow these domestic banks to take deposits from and make loans to non-U.S. residents without being subject to standard domestic reserve requirements or interest rate ceilings.
Okay, so think of a casino cruise ship. It docks right in the middle of the city, takes your money, but sails 3 miles out into international waters so it doesn't have to follow state gambling laws.
That's a great way to picture it.
IBFs are basically financial casino ships allowed to operate right in the middle of Manhattan as long as they promise to only let foreign passengers play at the tables.
The U.S. government allowed this because they realized they were losing immense amounts of financial business to London and Tokyo. They wanted to bring some of that massive Eurodollar action back to New York, even if they couldn't regulate it.
If you can't beat them, join them.
Pretty much. And the scale of what we are talking about is almost impossible to visualize. Let's look at the historical data points provided in our source stack to get a sense of the sheer size of this black hole.
Walk me through those numbers.
In May 1991, if you looked at the US M2 money supply, which is the standard metric economists use to measure the amount of money circulating in the domestic economy, it sat at about $3,396 billion.
So roughly 3.4 trillion.
Right. And of that domestic M2 number, the portion attributed to overnight Eurodollars was just $17.8 billion.
Which looks like a tiny, insignificant rounding error.
But that was just what the domestic metrics were capturing. If you look at Morgan Guarantee's estimates for the gross size of the entire euro currency market back in 1988, it was over $4.5 trillion.
Wait, really?
Yes. And they estimated that U.S. Eurodollars made up about 67% of that. So we are talking about a gross Eurodollar market size of over $3 trillion back in the late 80s.
Let that sink in. Decades ago, the unregulated, invisible shadow money supply was already matching the size of the entire, highly visible domestic U.S. money supply.
And according to the real-time analysis from Jeff Snyder at Eurodollar University, that system has only grown exponentially larger, more complex, and more deeply obscured from traditional economic metrics in the decades since.
Because it isn't just simple savings accounts anymore, right?
Yeah.
The market relies on highly complex, interlocking instruments.
Very complex.
I want to stop and clarify those instruments because the terminology gets dense in the sources here. They mention things like fixed-rate time deposits, Eurodollar CDs, floating rate notes, and note issuance facilities. Explain how these actually function in the wild.
A fixed-rate time deposit is simple enough you lock your money up for a set period at a set interest rate. But a floating rate note, or FRN, is a fascinating adaptation to risk.
How does an FRN work?
Imagine you are a bank lending $50 million for 5 years. What happens if global interest rates spike dramatically in year 2? You are stuck earning a low return while your own costs to borrow go up.
Right, you're losing money on the spread.
So an FRN solves this by floating its coupon payments. The coupon is just the periodic interest payment made to the lender.
Okay, so the interest rate changes.
Yes. Instead of a fixed 5%, the coupon is tied to a benchmark rate, plus a little extra margin. If global interest rates rise, your coupon payment automatically rises with it, protecting the lender from interest rate risk.
And what benchmark are they tying these floating rates to? Because for the longest time, whenever I read about international banking, it was always LIBOR.
The London Interbank Offered Rate. That was the foundational metric for decades. It was the average rate at which the major global banks estimated they could borrow from one another in the offshore market.
But as the source material notes, the system has undergone a massive transition away from LIBOR.
Due to various manipulation scandals and structural weaknesses, the benchmark has completely shifted. By mid-2026, the relevant rate anchoring this multi-trillion-dollar web firmly transitioned to SOR, the Secured Overnight Financing Rate.
But changing the benchmark doesn't change the underlying reality of the system. You still have a vast, interconnected, multi-trillion-dollar web of interbank liabilities operating almost entirely outside the reach of the Federal Reserve.
Which leads to the most obvious glaring question.
Right. If the U.S. government isn't controlling this ocean of capital, who is? Who is steering the ship?
And this brings us to Section 3, the relay model and the architecture of elite power. Because we are moving from the mechanical what of the Eurodollar to the structural who and how.
How does power actually operate in this shadow environment?
To understand governance in this system, we have to look at the relay power model of global decision systems. And the very first thing the relay model does is throw out the Hollywood villain archetype.
It explicitly rejects the idea of a smoke-filled room.
Exactly. There is no secret cabal of 12 billionaires sitting around a mahogany table in a volcano lair, deliberately pushing buttons to crash the housing market or inflate a currency.
It's way more boring than that, but also way more effective.
The truth is far more complex and, frankly, much harder to dismantle than a cartoon conspiracy. The relay model uses network theory to define power. It views global decision-making as a small world network.
Meaning everyone is connected.
Yes. Influence in this system is highly distributed, spread across thousands of nodes, yet it remains deeply hierarchical. Power doesn't flow from a single dictator, it travels through overlapping institutional layers.
Let's avoid getting bogged down in abstract math here, though. The model uses a specific metric called betweenness centrality. Explain that to me like I'm 5. What does it actually look like on a map of human networks?
Think of the game 6 Degrees of Kevin Bacon, where you try to connect any actor to Kevin Bacon through their co-stars.
Oh yeah, I love that game.
Well, Kevin Bacon has incredibly high between-centric centrality in Hollywood. He bridges entirely different genres and eras of film. In network theory, between-centric centrality measures how often a specific node, a person, or an institution acts as the shortest bridge connecting two other parts of the network.
So if I'm trying to move information or capital or legitimacy from the tech sector to the defense sector, the node that sits directly between them has all the power. They don't own the islands, but they control the toll bridge.
That is exactly the dynamic. A high betweenness score means you control the flow. Let's look at the specific scores from the relay model data to ground this.
Give me the breakdown.
In their aggregate network graph, they define a U.S. decision system root, which basically represents the entire metastructure of elite power. That scores at 0.5215. But let's look at the real-world institutions beneath that.
Okay, what does the Fed score?
The Federal Reserve itself scores a 0.0353. It sits as the ultimate bridge between sovereign government authority and the private banking core.
Makes sense.
The Securities and Exchange Commission, the SEC, is an incredibly strong bridge with a score of 0.0210, sitting squarely between the legislative branch making the laws and the capital markets executing them.
And what about the military?
The Department of Defense scores a 0.0151, acting as the massive bridge between government procurement budgets and the private defense industrial base.
So the model proves that power isn't about giving orders. It is about structural positioning. It's about being the unavoidable bottleneck.
Power, in this framework, is defined by 3 things: continuity, opacity, and aligned incentives.
Break those down.
You have the finance layer giants like BlackRock, Apollo Global Management, Deutsche Bank. You have the philanthropy layer organizations like the Open Society Foundations directing massive capital towards social causes. And you have the policy layer think tanks like the Center for American Progress or strategic advisory firms like West Exec Advisors.
And the people just constantly circulate through these nodes. It's the revolving door quantified.
Consider the career path of a high-level elite. They might start out regulating derivatives at the SEC, then they leave government and join a prestigious policy think tank writing white papers on the future of global finance.
And then a few years later, they take an executive role at a private equity firm, utilizing the exact regulatory frameworks they helped write.
Exactly. When the people regulating the banks are rotating into the think tanks and then into private equity firms, they don't need to conspire in a dark room. Their incentives naturally converge.
But here's the problem with that defense. I have to push back a little.
Go for it.
If it's not a coordinated conspiracy, why does it look so incredibly suspicious to the outside observer? It looks like a planned attack when all these institutions move in lockstep.
It looks that way because of incentive convergence. Think about traffic routing apps like Waze.
Okay.
When there's an accident on the highway, Waze automatically reroutes thousands of drivers through a quiet suburban residential street. Suddenly, there is a massive synchronized traffic jam in a neighborhood.
Right.
No single driver maliciously orchestrated that jam. There was no secret meeting. But because every individual driver was using the exact same algorithm, optimizing for the exact same goal, the path of least resistance, a synchronized massive movement occurred organically.
That makes perfect sense.
Yeah.
The algorithm for these elites is the pursuit of yield, the optimization of regulatory avoidance, and the preservation of institutional continuity.
Precisely. Yeah. Because they all share the same elite education, the same professional networks, and the same risk models, they act in unison without ever having to explicitly collude.
But while the system is not a conspiracy, its structure, which is so reliant on opacity and overlapping institutional trust, makes it highly vulnerable to exploitation by bad actors.
Extremely vulnerable. Which brings us to Section 4, Southern Trust and the Dark Nodes of Concentration. And honestly, this is the most shocking data point from the relay model analysis.
We have to talk about Jeffrey Epstein and the Southern Trust Company, because when I read this in the source stack, I had to read it 3 times to actually believe it. Here's where it gets really interesting.
Remember the betweenness centrality scores we just discussed. The entire U.S. Department of Defense, with its billions in budget and global reach, scored a 0.0151.
Right.
Jeffrey Epstein's Southern Trust Company, a single entity, scored a 0.0180.
I want the listener to really absorb that. A single financial vehicle associated with a disgraced, convicted sex offender mathematically outranked the entire U.S. Department of Defense in terms of structural bridging power within this elite network graph.
It is staggering when you look at the raw data.
How on earth does a single LLC achieve that kind of systemic influence?
It achieved it through the precise exploitation of network bridges. Southern Trust was registered in the U.S. Virgin Islands in 2013. Its official incorporation documents stated it was a genetics research firm.
Which is absurd because it was doing absolutely zero genetics research.
None. It had no laboratories, no microscopes, no scientific staff, no export activity whatsoever.
Yet the Virgin Islands Economic Development Authority granted Southern Trust massive, incredibly generous tax exemptions.
And the authorities explicitly cited the company's, quote, promising contributions to the life sciences sector as the justification.
So what was it actually doing if it wasn't sequencing DNA?
The reality is that tax filings indicate Southern Trust declared earnings of over $200 million across a 5-year period. It was functioning entirely as a financial vehicle.
A mechanism for payments and banking access.
Right. It was a node for clearing payments, structuring transfers, and maintaining vital banking access across Epstein's global network, completely insulated by the facade of a tech startup.
I'm stuck on the mechanics of this, though. How does a fake genetics company move $200 million through the global banking system without a compliance officer blowing a whistle and freezing the accounts?
To understand this, we have to make a crucial distinction outlined in the source text. There are different types of shadow mechanics at play here.
Walk me through them.
The Eurodollar system we've been discussing, the bank funding and reserve avoidance, is fundamentally different from tax haven secrecy.
Which is what we saw exposed in leaks like the Panama Papers and Paradise Papers.
Exactly. Those deal with profit shifting and hiding ownership. And both of those are distinct from structured private credit, which involves moving risky assets off a bank's official balance sheet for accounting purposes.
Right, so they are 3 different tools in the shadow toolbox.
But really, nodes like Southern Trust utilize the underlying logic that connects all offshore systems, the optimization for legal defensibility and administrative room to maneuver.
They exploit the culture of the offshore system.
Yes. Epstein's team used the language of innovation. By utilizing the semantics of health and tech, they provided a narrative facade for the compliance departments of major banks.
It allowed a reputationally toxic individual to retain influence and re-enter the financial mainstream by just dressing up as tech.
The sources mention that one official literally referred to Southern Trust as a narrative device.
That phrase is chilling. A narrative device. It was just a story they told the paperwork.
It proves that this shadow system is not just an abstract spreadsheet of numbers reacting to interest rates. It represents a profound structural vulnerability to well-financed fictions.
Because Southern Trust didn't succeed due to some highly sophisticated technical glitch in a banking algorithm.
No, it succeeded due to an institutional absence of scrutiny at every single turn.
The systemic blind spot. The banks saw the VIP status, they saw the US VI tax exemptions, they saw the buzzwords about life sciences, and they simply chose not to look any closer. The network naturally protected itself.
So, we have built a picture of a system that is astronomically large, operating largely outside the view of domestic regulators, governed by structural networks of revolving door elites, and highly susceptible to dark nodes of concentrated opaque wealth.
Which naturally leads to the ultimate question. What happens when a massive, unregulated, opaque system like that starts to break down?
And this brings us to Section 5, warning signs in the system, specifically looking at a collateral freeze. Because we are transitioning to the present day using Jeff Snyder's warnings.
The Eurodollar system isn't some stable, well-oiled machine, is it?
It is deeply fragile, and right now, the warning lights on the dashboard are flashing red. Snyder is pointing directly at a collateral freeze.
To understand a collateral freeze, we have to understand the repo market, which is basically the beating heart of the Eurodollar system.
Repo stands for repurchase agreement. It is how banks borrow massive amounts of cash overnight to balance their books.
Walk me through a repo transaction. Let's make it tangible for the listener.
Think of the repo market like a massive high-end pawn shop for banks.
Okay, pawn shop.
Let's say a major bank in London urgently needs $1 billion in cash just to meet its obligations by the end of the day. It walks into the global pawn shop, it hands over $1 billion worth of pristine collateral, usually U.S. Treasury bills.
The Rolex in this scenario.
Exactly. The counterparty takes the Treasury bills, hands over the $1 billion in cash, and the London bank agrees to buy those Treasury bills back the very next morning, plus a tiny bit of interest.
And if the London bank goes bankrupt overnight and can't pay the cash back, the counterparty simply keeps the U.S. Treasury bills, sells them, and makes their money back. It's incredibly safe.
As long as everyone trusts the collateral. But according to Snyder's analysis of the current data, that trust is evaporating.
Where is he seeing the stress?
He points specifically to Japanese government bills as being at the epicenter of this stress right now. But the issue is systemic. The global pawn shop is starting to reject the Rolexes.
Snyder highlights a massive $3 trillion repo warning. He notes that SOFR rates, that new benchmark we talked about earlier recently, broke above the Federal Reserve's target rate. Why is a slight bump in an interest rate terrifying to someone who watches the plumbing?
Because of the context of the reserves. Right now, the global banking system is sitting on roughly twice the amount of bank reserves it had during the infamous 2019 repo crisis.
When the market briefly seized up before.
Right. Theoretically, there is an ocean of cash available. So if there is so much cash, why are banks demanding higher and higher interest rates to lend it out overnight?
Because they are hoarding it.
It's exactly. A rising rate in an environment flooded with cash means the banks do not trust the collateral being offered, and they are starting to not trust each other. They would rather sit on their cash than lend it out, even for a few hours.
And then you have the 4-week Treasury bill auctions. Snyder mentions recent auctions where the low bid was 0.
A 0% return.
And my immediate reaction reading that was, why on earth would a massive profit-driven financial institution lend money to the U.S. government for 0 return? It defies the basic logic of capitalism.
It defies the logic of a healthy market, absolutely. But it perfectly explains the logic of a panic.
How so?
In a normal environment, you seek a return on your capital. You want interest. But in a shadow banking crisis, the return of your capital becomes infinitely more important.
Oh, wow. So they just want to make sure they don't lose the money.
These institutions are so desperate to get their hands on pristine, unquestionable collateral like a 4-week Treasury bill so they can survive the night in the repo pawn shop that they are willing to forfeit any profit entirely. They are paying a premium just for safety.
Snyder also points to swap spreads making monumental moves. And I have to admit, swap spreads sounds like a phrase designed to put normal people to sleep.
It's very dense jargon, yeah.
Let's translate that into English. Why do wild moves in swap spreads signal a systemic freeze?
An interest rate swap is basically an insurance policy where a bank swaps a variable interest rate for a fixed one. The swap spread is the difference between the fixed rate on that private bank swap and the yield on a remarkably safe U.S. Treasury bond of the same maturity.
And usually the private bank rate is higher, right? Because banks are inherently riskier than the U.S. government.
Exactly. I would demand more interest to lend to Citibank than to the U.S. Treasury.
So what does it mean when the spread moves?
When swap spreads go negative or experience these monumental erratic swings, it means the mathematical relationships underpinning the global financial system are breaking down. It signals that balance sheet capacity, the willingness of major dealers to actually facilitate trades and absorb risk, is shrinking rapidly.
It is a massive surge in liquidity hoarding worldwide.
A total freeze-up.
Okay, but let me play devil's advocate here. If the Eurodollar system is fundamentally an offshore system, built outside the U.S., trading between banks in London, Tokyo, and the Caymans, why does a freeze there crash the domestic U.S. economy? It feels removed from the reality of a guy buying groceries in Ohio.
It's a great question. Think of the Eurodollar market as a massive offshore power grid.
Right.
The U.S. government doesn't regulate it. They don't inspect the transformers. They don't oversee the engineers. But the reality is our domestic hospitals, our public schools, and our largest corporations have secretly run extension cords out into the ocean and plugged directly into it.
So if that offshore grid goes dark, Main Street loses power immediately.
Exactly. We still lose power. And Snyder's pointing out that the lights on Main Street are already flickering. He connects this esoteric, invisible plumbing directly to the real economy.
Yeah, The sources mention some real-world examples. He points to the CEO of Delta Airlines recently admitting that flights are unexpectedly emptying out. He points to Wendy's struggling, and the CEO of McDonald's explicitly stating on earnings calls that low-income consumer traffic is collapsing.
Because when the Eurodollar system restricts credit, when the offshore banks stop lending to the corporate world, the lifeblood drains out of global trade.
Companies can't finance their supply chains, they cut back on hiring, they lay off workers, and the consumer gets tapped out.
It hits the real economy incredibly fast.
Now, I want to pivot to a perspective from our source stack that takes this systemic fragility to its absolute extreme. We are bringing in the analysis from Catherine Austin Fitts and the Solari report.
This is a fascinating addition to the stack.
And I want to be very clear to the listener here. We are impartially reporting on the economic theories presented in the source material. We aren't endorsing them, but her read on the macro situation is incredibly stark and thought-provoking.
It is a radical reframing of recent history. Fitts argues that, structurally speaking, the global economy actually died roughly 15 years ago.
Pointing back to the systemic collapse during the 2008 Great Financial Crisis.
Yes. She argues that the patient flatlined on the table in 2008.
And her thesis is that everything we have experienced since then, the booming stock markets, the supposed economic recoveries, has not been organic, productive economic growth.
It has been a facade maintained entirely by unprecedented money printing by central banks.
Just pumping trillions of synthetic dollars into the system just to keep the corpse twitching.
Essentially, yes. And she argues that historically, printing that much money would cause immediate catastrophic hyperinflation.
Like Weimar Germany or Zimbabwe.
Right. But it didn't happen here, primarily because that inflation was offset by the deflationary forces of cheap offshore manufacturing in places like China and the continued expansion of the offshore Eurodollar system absorbing the excess capital.
But she argues we are hitting the wall now. The debt burden has become mathematically unsustainable, and you can't rely on cheap foreign labor to hide the inflation forever.
Which leads to her incredibly controversial analysis of the 2020 global lockdowns.
This part blew my mind. Walk us through her logic here.
Fitts suggests that if you view the 2020 lockdowns strictly through a monetary and financial lens rather than a public health lens, they served a vital structural purpose for the central banks.
By forcefully locking down the global physical economy, you intentionally crash the velocity of money.
Yes.
The velocity of money being how fast a single dollar bill changes hands. Like, I buy a coffee, the barista uses that tip to buy a bus ticket, the bus driver buys a newspaper. When everyone is locked in their house, the velocity drops to near zero.
Precisely. In her view, crashing the velocity of money was a necessary monetary maneuver. If velocity plummets, central banks suddenly have the cover to print $6 trillion in emergency liquidity to plug the gaping terminal holes in the shadow banking system without instantly triggering hyperinflation on Main Street.
Because if velocity was high, that $6 trillion would have caused prices to quadruple overnight.
That's the theory.
So the argument is that stopping the physical economy of normal people was the only mathematical way to perform emergency, multi-trillion-dollar surgery on the failing shadow financial economy without blowing up the currency.
It is a heavy, heavy concept to digest. It reframes the last several years entirely.
It really does. It highlights the ultimate vulnerability of the system. Because whether you look at Snyder's repo warnings or Fitts' macro timeline, the conclusion is exactly the same. The offshore black hole is unstable.
Which leads us to Section 6, latent dominance, the Fed's ultimate lever.
Right, because if the Eurodollar system is offshore, if it's freezing up, and if it's threatening to take down the domestic economy, what can the Federal Reserve actually do about it? They don't regulate it. They don't control the banks issuing the loans in Frankfurt or Tokyo.
This brings us back to the relay power model and a concept they call latent dominance. It is vital to reiterate. The Federal Reserve does not govern the day-to-day expansion or contraction of the Eurodollar black hole. They are not steering the ship.
They can't tell a bank in Frankfurt to stop issuing dollar loans.
No, they have no jurisdiction. However, they retain one critical, absolutely vital, systemic lever, central bank liquidity swaps.
Okay, explain how a liquidity swap works in a crisis.
Let's go back to our pawn shop analogy. The Eurodollar market freezes. The London bank can't get dollars to pay its debts.
And if it defaults, it takes down a dozen other banks with it.
Exactly. Now, the European Central Bank, the ECB, desperately wants to save the London bank, but the ECB can only print euros. They can't print US dollars.
So they call the Federal Reserve.
And the Fed executes a swap. The Fed creates US dollars out of thin air and trades them to the ECB in exchange for an equivalent amount of euros.
So now the ECB has the US dollars.
Yes. The ECB then lends those dollars to the desperate London bank, saving it from default and preventing the Eurodollar system from collapsing.
So the Fed is basically holding the only fire extinguisher in a massive, totally unregulated fireworks factory.
That's a brilliant way to put it.
They aren't in charge of safety. They don't inspect the fuses. They can't stop the workers from smoking on the factory floor. But they possess the ultimate power when the match is finally struck.
They act as the ultimate backstop of last resort for a system they do not control. But here's the most fascinating development outlined in our source stack regarding government strategy.
What's changing?
The realization that this shadow system is uncontrollable is actually forcing a massive strategic shift in how the U.S. government operates in the physical world.
You're talking about the shift from reactive bailouts to proactive industrial policy.
Yes. Let's compare two eras of government intervention. During the 2008 Great Financial Crisis, government intervention was entirely reactive.
The massive bailouts of General Motors, Chrysler, AIG, and the big banks through the TARP program.
Right, these were desperate, panicked measures. The government was throwing life preservers to sinking ships to stop the economic contagion from destroying the country.
But if you look at the Deloitte insights and the corporate analysis in our sources today, the strategy is completely flipped.
It has. The U.S. government is currently pouring billions of dollars into companies like Intel, MP Materials, NVIDIA, and vast networks of defense contractors.
And these are not distressed companies on the verge of bankruptcy. They are highly profitable entities.
The government is making proactive, strategic investments.
They are making strategic moves to fundamentally secure physical supply chains. They are trying to guarantee domestic capacity for semiconductor manufacturing, secure access to rare earth minerals, and maintain absolute technological dominance in artificial intelligence.
And why the sudden shift to physical industry?
Because policymakers are slowly realizing a terrifying truth. If they cannot regulate the ethereal offshore shadow system of Eurodollars,
If they cannot control the financial weather.
they absolutely must actively fortify the hard, physical, and strategic base onshore. They are building an agile regulatory system to coordinate the private sector against geopolitical and financial threats, rather than just waiting with the fire extinguisher for the next offshore banking failure.
It is a profound shift in national security strategy, driven entirely by the uncontrollable nature of the Eurodollar.
Okay, we have covered a truly massive amount of ground today. Let's do a quick recap to tie all these threads together.
We started by looking at the genesis of the Federal Reserve, an institution created as a political compromise to stop devastating banking panics and rein in the monopolistic power of the New York Money Trust.
But we saw how capital, relentlessly seeking higher margins and fewer rules, simply slipped the leash. It moved offshore, creating the Eurodollar system, a multi-trillion-dollar shadow banking network operating entirely outside U.S. jurisdiction.
Then we explored the reality of power within that system. Using the relay model, we saw that influence doesn't flow from a centralized conspiracy, but through the revolving doors of finance, philanthropy, and government.
We saw how dark nodes, like Jeffrey Epstein's fake genetics firm, Southern Trust, actively exploit the opacity of this offshore logic to concentrate wealth and power without ever triggering institutional alarms.
And finally, we looked at the real-world consequences, the flashing red warning signs in the collateral markets today, the freezing of global liquidity in the repo pawn shops, and the Fed's ultimate latent power as the crisis backstop.
Even as the U.S. government radically shifts its strategy toward proactively securing domestic, physical supply chains.
It's all connected.
The most important question is, why does any of this matter to you? Why should you, listening to this, care about note issuance facilities or the repo market or betweenness centrality?
Because it's not just theory.
No, because this invisible shadow system dictates the hard realities of your life. It dictates the real-world cost of living. It determines the stability of your retirement accounts, the interest rate on your mortgage, and the hidden structural forces steering the policies of your elected government.
When the massive, unregulated Eurodollar system sneezes, the Main Street economy catches a severe cold. We are seeing it in emptying airline flights and collapsing fast food traffic right now.
Understanding this infrastructure is the only way to comprehend the macroeconomic environment we actually live in, as opposed to the simplified, closed-loop models they still teach in economics textbooks.
Which leads to a final thought for you to chew on as you go about your day.
We started this deep dive asking you to look at the dollars in your wallet, operating under the assumption that the United States government issues the world's money.
But if the Eurodollar system is vastly larger than our domestic money supply.
And it operates almost entirely outside U.S. borders, totally free from U.S. banking regulations. Who actually issues the world's reserve currency?
Right.
Is it the United States government?
Or is it a decentralized, invisible network of offshore shadow banks that answer to absolutely no one?
It is the defining financial question of our era. Keep digging into the sources, keep questioning the mechanics of the world around you, and we will catch you on the next deep dive.